Hello, I'm Ryan Lightfoot Aminoff of Fund Caliber, and today I'm joined by Neil Robson, elite rated manager of the Threadneedle Global Extended Alpha funds. Neil, thank you very much for your time today.
Good to see you.
Now, just first of all, just going to turn our attention to the name of the fund. You have an extended alpha fund. With that, you've got a 130-30 structure. All of those are very complicated terms. So maybe you can explain just a little bit what that means in sort of layman's terms, please.
I will do. So, the vast majority of funds you deal with are long-only 100% equity type funds. This is a 100% equity type fund. We have 100% exposure to the market, but we have the opportunity to short some stocks. Now, shorting immediately makes people worried. Is it a hedge fund? It's not. It's quite simply saying, actually, by shorting this one stock, I can actually own more of what I really like and therefore add more value in the process. If you like, it's more stock selection at alpha embedded by design. It's as simple as that.
With that shorting companies, so that's where you're making money from potentially falling prices.
Yep.
This has been a lot harder in the last few years, where we've seen central banks sort of printing money and putting that into stock markets, skewed things a bit. We've seen some of those sort of, they're calling them meme stocks of short squeezes and things. Now central banks are reversing that with people going back to work and not being able to short as much at home. Is it making shorting stocks a bit more effective?
I would agree with you that ever since the global financial crisis, the amount of money being pushed into the system by central banks has made markets go up. Valuations have gone up, and therefore shorting against that rising market is difficult. But then ask yourself the question, what are we trying to achieve with the shorts? If I could actually just have something that underperforms the market, or more importantly, underperforms the other stocks in the portfolio, if I could get 5% differential between the stocks that I'm long and the stocks that I'm short, that's up to another 150 basis points of stock selection alpha in the portfolio. And the other thing I would say is that, actually always in the market, there are some companies who just do badly. So, if you just take an example of, e-commerce, everyone can tell me about e-commerce and how it's taken, all the business off department stores and made lots of department stores go bust. That's been true for 20 years. You could have embedded that into this portfolio. So in a long-only portfolio, you'd have been restricted to perhaps owning Amazon. This time, you could have shorted department stores on the other side and made money out of the same research process that's driving you alongside. So I think there are always opportunities, even on the short side.
Interesting, thank you. And now ESG has been a super buzzword around the industry for a long time, but you integrate it in your process. Do you use it with sort of identifying shorts as well? So do you look at where companies would have sort of bad ESG scores, whether that's an opportunity to make money on either side?
So maybe I'll backtrack and just let's say, what are we looking for when we're looking at any company? And we're looking for something that is durable over time. So on the long side, we would refer to ourselves as a quality growth manager. We want to invest in businesses that are good, and that will continue to compound over the medium and long term. If I look at examples that are in the current portfolio, Alphabet or Google, we first bought into portfolios in 2005 and has been there ever since. That might not surprise you in the case of Alphabet, but we have a business like Union Pacific running freight trains around the west of the US. That's been in the portfolio since 2008. So it's because we have this long-term desire to be with companies that we need to check them from every single possible angle. So, does Alphabet have the right balance sheet in order to do its business plan? Are there any ESG issues that are going to get in the way of that business plan, or that they have to, would make us concerned as investors over the medium term? Same on the short side. First of all, we're not someone who is trying to short something for next quarter's earnings. To be honest, we're probably not very good at that. I think the longest serving short position in the portfolio was 6 years continuously. Because in the same way, there are good, competitively advantaged businesses that compound out over time. There are businesses that are just holed under the waterline, who have faced tough competitive environments, might have the wrong balance sheet, and persistently underperform over long periods of time. So yes, we use ESG continuously, but it's part of the overall investment case that we're building either on the long side or the short side. If you like, by itself, it's not sufficient in order just to drive an investment case. It has to be part of the whole.
Interesting, thank you. And some of your biggest shorts today are in sort of the financial sector. It's a very broad sector. So what exactly is it in the financials that you're sort of shorting?
Okay, well, going back to your earlier comment about, we've had, was it 13 years post GFC now of money being pumped into the markets and so on. We're leaving that environment. We had a period for 70% of the time since GFC, we've had zero interest rates. As we all know now, we're leaving that period of zero interest rates, and life is getting tougher. In particular, valuations of all assets, but equities as well, are coming down. And if you think about it in the financial area, we have a series of businesses, including our own, whose revenue is very much linked to the level of markets. So in the portfolio, it acted as a very good beta hedge to the portfolio to have some shorts in the likes of asset managers and so on. That's not enough for us. We don't do big macroeconomic type positions. So, if I look at the individual names, we have a short of a private equity manager. Why is that? Well, actually, we're partially hedging a position in a bank called SVB Financials, which we think is one of the best growth banks we can come across around the world. But it is very exposed to that capital call banking volume, which is associated with private equity. So it acts as a deliberate hedge there. And then we have another example of a financial platform who you will probably know. We don't name our shorts because we like to have good relationships with companies, but a financial platform where we think there is a significant rise in competitive environment there, and something that was very highly valued. First of all, because interest rates are going up, it's probably become less valued, but also because actually they're going to be probably less profitable than they were before. So financials, overall, it's a great position to have that helps hedge the rest of the portfolio, but also very, very specific in terms of the names that we actually have.
Thank you very much for that. And now finally, we have talked about a couple of stocks you like, sort of Alphabet and Union Pacific, that you have held for the long term. But thinking sort of into the future now, are there any sort of examples of a couple of stocks you like for the long term going forward?
Yeah, well, I mean, we're in a very difficult environment in markets at the moment. Interest rates are going up. We don't know how much. Inflation is with us. We don't know how long it's going to stay. Those are the sorts of, it's causing a great deal of uncertainty in markets, and markets are significantly off their highs. So what sort of businesses do you want to, or can have confidence in investing in that sort of environment? And really going back to the very heart of our philosophy, we want quality compound growth businesses. So attached to trends that aren't just going to happen for the next 6 months, but will be happening for the next 10 years. We all know about cloud computing. In the same way that e-commerce has been going on for 15 years, cloud computing is just in its infancy. We're less than 10% penetrated in terms of the enterprise spending on computing. And what's wonderful about it is that basically 3 companies share the oligopoly that's delivering that to companies. So, it's AWS, Amazon Web Services, it's Microsoft Azure, and distant third, Google. So if you take a business like Microsoft, Microsoft has strongly attached to that trend. It's a name that companies trust to deliver to them. That's in the latest quarter, year-over-year growth was 17% in its revenue line. If you take kind of mid-teens in 5 years' time, that will roughly have doubled earnings. Maybe it's a little bit slower because of the environment we're in. Maybe it's a little bit faster because the efficiency of it actually dictates that companies accelerate their adoption. But roughly, say it's roughly doubled earnings in 5 years' time. At the moment, you pay about 23 times forward earnings, which is a premium to the market, which is typical for the sorts of names that we have. But if it doubles earnings, it will trade at a discount to the market in 5 years' time. We don't believe that will be true. And therefore, we believe that Microsoft will outperform. Or reverse it. Ask yourself, what level would bond yields need to be for Microsoft to trade at 12 times earnings? And I just, I can't conceive that. So Microsoft, I think, is a great example. Amazon through AWS would be equally as good. Another one, moving across, maybe talk about healthcare. We have a business called Novo Nordisk in the portfolio. We actually also have a business called Eli Lilly, and they're both making a really interesting change in society, really. And that, we all know of the obesity in society, how much it's developed over the years. I think there are something like 42% of Americans now who are classified as obese. Amazingly, 9% are classified as clinically obese. That's of the adult population. So it's we know what problems it causes. It causes problems in terms of development of type 2 diabetes, coronary heart disease, blood pressure related issues, and so on. What they have through their diabetes franchise is developed a series of drugs called GLP-1s. That mimics the behavior of a hormone. So when we eat, this hormone is released and it makes us feel full. And what they noticed as a side effect was that people who were on this for diabetes actually tended to lose weight. They've now optimized these things, and over a slightly longer than a 12-month view, Novo's drug reports a 15% weight loss, and Lilly's drug a 22% weight loss, which personally I could do with. But I think there's a really good example of a market that is going to develop, which probably could be as big as the diabetes market itself. But also is good for society. And again, it's a duopoly in this case between two companies. There will be fast followers, but they are probably at least 5 years behind them. So, again, in an uncertain economic environment, I think those are, two very well-placed companies whose development is kind of independent of what's happening around them.
Well, that's been really interesting, Neil. Thank you very much for your time today.
Okay. Thank you, Ryan.
And if you'd like to find out more about the Threadneedle Global Extended Alpha Funds, which is elite rated by Fundcalibre, please visit our website, fundcalibre.com. And for more from our video series, please don't forget to like and subscribe below.